And it's a bite. It catches a lot of people off guard, and that's before you go over to the federal taxes, and that can be 20%, and then state 5%. So just be aware of it and be prepared for it.
Sure. Hey guys, sole proprietor taxes. We get asked questions about this all the time. Ray and Andrew here. Ray, what can you tell us about sole proprietor taxes?
So Andrew, whenever you first start your business, most business owners will start out as a sole proprietorship, right? That's if they haven't made any corporate elections, they're not a partnership or anything like that. It's just one guy out there working, one man or woman out there working. You pretty much start off as a sole proprietorship. And when you file your taxes as a sole proprietor, you're going to do it on your 1040, right? So it goes on your individual tax return on what's called a Schedule C. Now on that Schedule C form, it's a pretty simple form, right, for most people. It's simple for us, but, right?
It's supposed to be the most simplest way to file your business.
It is. So on that Schedule C, you know, it's going to have some information about the business, but it's also where you're going to put your revenues, and you're going to put your expenses, which are your tax deductions, like automobiles, meals, your payroll expenses, things like that, home office deduction. And then, so what you're going to do is you're going to start off with your gross sales, and then you're going to work your way through your expenses all the way down to net income. That net income, and this is probably the most important thing to understand about a Schedule C filer, is that your net income is going to have what's called self-employment tax on it, right? That self-employment tax is 15.3%. If you remember when you actually worked for somebody and you got a W-2, an actual wage, if you remember on your pay stub, you would have money come out for Social Security and Medicare. Well, that was 7.65% of your wages. Your employer matched that 7.65%. So in total, it's 15.3%. Well, when you work for yourself as a sole proprietor and you file on a Schedule C, all of your net income has that 15.3% applied to it. So let's say you gross $200,000 in sales, you have $100,000 in expenses, you net $100,000 net income. You're going to pay $15,300 right off the bat on that $100,000 of net income. That's before it even gets over to the ordinary federal income tax, which is going to be probably, you know, I tell people around 20%, and then you got state taxes, which are around 5%. So when you net $100,000 as a sole proprietor, you don't have $100,000. You need to put money away, right? And I tell our sole proprietors to put away anywhere between 30 to 35% in anticipation of having to send that money to the IRS. You know, for the first year, you can really kind of keep that money off to the side, but then we do recommend you start making estimated tax payments at least on a quarterly basis. We'd like for you to get those taxes to the IRS versus waiting till tax time, because a lot of things can happen. Once you cross that tax year and you wait till April, something could happen. You could end up using that money for other reasons and then owe a really large amount of tax. It's one of the common problems we see with our small business owners who files a Schedule C, of them not putting enough away for taxes and not have the money whenever the tax comes due. So we recommend that you do proactive tax planning. We sit down and look with you back in like November, December timeframe. We look and see if, you know, how much we think you're going to owe, see if there's any opportunities for restructuring the business, make it a little bit more tax efficient, or if there's some things you can do before year-end with retirement plans or equipment purchases, things like that, to reduce that tax burden. Right. So it's real important to be proactive, especially when you're a Schedule C. So by all means, when you get, you know, if you are a small business owner or Schedule C and you're concerned about taxes, go to our website, rehcpas.com, fill out the Contact Me form. We'll reach out to you and see how we can help make sure you understand your tax obligations.
Yeah, it's really important to know that self-employment tax is in addition to your ordinary income
Absolutely.
tax.
So yeah, you'll pay that $15,300, and there's nothing that cuts into that. It just happens.
Right.
I mean, and it's a bite. It catches a lot of people off guard, and that's before you go over to the federal taxes, and that can be 20%, and then state 5%. So just be aware of it and be prepared for it.
Sure. Thanks for going through that with us. So again, hopefully that you found that video helpful. That's Sole Proprietor Taxes Explained. Again, this is Ray and Andrew. If you like this video, please subscribe to our YouTube channel and see what else we put out there. Thanks.
Thanks.